Good day and welcome to the Pennar Industries Limited Q1 and FY2024 results conference call hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. This conference may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Vikram Suryavanshi from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Doreen. Good morning and very warm welcome to everyone. Thank you for being on the call of Pennar Industries Limited. We are happy to have with us management of Pennar Industries today for question and answer session with investment community. Management is represented by Mr. Aditya Rao, Vice Chairman and Managing Director, Mr. Srikanth Bakkar, Chief Financial Officer, Mr. Manoj, Head Corporate Planning, and KM Sunil, VP Investor and Media Relations. Before we start with the question and answer session, we will have some opening comments from the management. Now I hand over call to Mr. Aditya for opening comments. Over to you, sir.
Thank you. I'm grateful for the moderators and all of our stakeholders present on this call today for their participation in today's discussion on Pennar Industries Q1 FY24 financial results. If my voice isn't audible or if there's a problem hearing me, please let me know. We will begin by discussing our profitability, followed by our liquidity and growth. Subsequently, our CFO, Mr. Srikanth, will share his insights on our financial performance. After his presentation, we will be open to answering any questions you may have. So let me start off with our summary. In the first quarter, we reported net sales amounting to INR 748.9 crores with a PBT of INR 29.5 crores. This reflects a 7% increase in our net sales and a substantial 57.2% rise in PBT. Our cash profit for the quarter was INR 38.2 crores compared to INR 29.9 crores in the Q1 of last year. The quarter is in line with our forecast, and we are confident that our profitability will continue to grow and scale in the coming quarters. Now, for Q1, our PBT, as I mentioned, stood at INR 29.5 crores, reflecting a margin of 3.9%. In line with our commitments, we anticipate enhancements in our PBT margin as we shift from revenue with lower margins to revenues that offer higher margins and superior capital efficiency. So our cash PAT for Q1 amounted to INR 38.2 crores, and this was achieved at a margin of 5.1%. As of June 30th, our working capital days stood at 74 days. The annualized ROCE for the quarter was 21.7%. Now, we had previously communicated our goal to surpass a ROCE of 20% by March 2023, which we had achieved, and we are pleased to announce that we continue to trend above that. Now, for the financial year, we aim for a ROCE of 22%, and our long-term target for our ROCE is at 25%. We've set a target of achieving 72 days in working capital by September, and we're confident we'll be able to achieve that. Moving into the next quarter and the fiscal year, Pennar's primary growth catalysts are projected to be our PEB division, our US subsidiary, PGI, our body and white business, and our industrial components business. Specifically our hydraulics revenue, which will scale well over the course of this year. So our ongoing initiatives in hydraulics, large diameter tube, and our module business are in progress, and we are optimistic that once finalized, these business units will play a pivotal role in driving our revenue growth for this year and for the next. In conclusion, that encapsulates our performance for the quarter, highlighting our profitability, liquidity, and growth trajectories. I'd now like to pass the conversation to Srikanth for his insights. Thanks.
Thanks, Vikram. Welcome to the shareholders on the first quarter of FY24 earnings call. The key metrics, as you would have seen the increase in terms of revenue by 7%, EBITDA by 32%, PBT by 57%, and cash PAT has increased by 28%. With our continued focus to improve the margins and cut down on the sales with the lower margin sales, we see the increase in the profitability, and the sales revenue remains flat. The revenue remains flattered because of the decrease in the sales of certain margins, certain jobs which we are not doing. Interest cost has been high due to the increase in the working capital in the business, which is slightly increased, and we expect this to moderate over the next 2 quarters, definitely by next quarter, but over the next 2 quarters. Our other income includes deposit income from mutual fund, incentives, write back, and the collection of old receivables. Salaries have increased due to deployment of higher manpower in our higher growth verticals, which is BIW, boiler, PEB, and also due to the increase in our ascent revenue and increase in the business. With this, I would like to hand over the call to the moderators for the Q&A sessions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dilip Kumar Sahu, an individual investor. Please go ahead.
Yeah, hi. Am I audible?
Go ahead.
Yeah. So the first question, Mr. Aditya, is regarding the steel tubes business. For quite some time we have been talking about a scale up in this business, and if you look at the sector as a whole and the participants in that, everybody is, I think, doing extremely well. So my question is that why is our tubes business in general, and steel tubes, which is a very small portion, I understand, is not really reflecting the market optimism? That's question number 1. And question number 2 is, for quite some time we have been talking about this capital efficiency, 3% interest rate, 75 days working capital days, etc. But it keeps on, there is no stability in that number. Sometimes we do well, sometimes we slip. Of course, there are reasons always, but somehow we are not there in a stable capital efficiency metrics. That's my second question. If you can just go through and can give a detail about the Accent business in terms of what is happening there, what is the numbers a little bit in detail, so that will help. These are my questions.
Thank you. With regards to your question on our tubing business unit, you're absolutely right. There has been a very moderate level of growth in profitability and not much growth in revenue as far as our tubes business is concerned. The reason for that is we've been prepping our entry into the large diameter tube business, which we believe can increase our revenue by a significant amount. That project is currently underway. It will be commissioned over the next few quarters. I'll have an exact date for you as we get closer. But you are right in that what we have seen in the market where other tube manufacturers are scaling quickly, we have not followed that because we have not, quite frankly, expanded capacity or commissioned expanded capacity. We are now doing that, and we're doing it for a product range which is higher margin than our existing tubes operating margins, and also has tremendous export potential as well. It also has some applicability internally where a hydraulics business as an input raw material can take some of those large diameter tubes as well. So I'm confident that this business is going to scale in the future. We have defined steel tubes as one of our major growth verticals over not just 1 year, but over the next 5 years. So we will be completing our capital deployment in this business, and we will make sure we will scale. From a capital efficiency point of view, you're right, interest costs this quarter trended higher. This is a temporary output of us having stocked up on a certain larger order book, a certain amount of current asset. We expect this to moderate very, very quickly. I mean, it's already, frankly, quite moderated over the last couple of months since the end of June. And we expect this by the next quarter, you will see a very significant moderation in this number. Additionally, from a ROCE point of view, we do target, as I said, about 20%. In the longer term, while you may see hysteresis on a quarter-to-quarter annualized basis, I can commit to you that we are targeting 25%, and year-on-year, you will only see our ROCE, our return on capital employed, and our return on equity increasing. We have now reached double-digit return on equity as of this quarter annualized, and we expect to be able to improve on that as well. So, capital efficiency within a quarter, hysteresis as we look at acquiring current assets for certain reasons, maybe with raw material price increases or to head off a certain any price increase or supply availability issues. You may see some, but overall I can commit to you about 20% annualized we will always meet, and a consistent improvement over year on year to 25% is also something that I can commit. That's the capital efficiency metric answer to your question.
Yeah, accent business, if you, specific to accent business, the thing that I wanted to know is, obviously we have extremely bloated up people cost in accent business, in anticipation of both profitability and volume of business. So, is the business now profitable, number one, and number two is, what kind of optimized revenue you are looking from accent to justify the kind of investment both in people as well as in fixed capital that we have spent?
Okay. So Ascent, which is our subsidiary in the U.S., currently is our most profitable business. It comprises about 30% of our overall yearly profit, and that trend is supposed to continue. Just one business unit doing that. And from a growth aspect, they are continually improving their profitability. This quarter compared to last quarter, you may see, Q1 to Q1, because we did have a large order go out last year in the comparable quarter. But if you compare the year in question, you will see consistent revenue rise, consistent profitability rise. The reason for that is Ascent's addressable market in the U.S. is much larger than our metal buildings market in India. In India, if it's about 1 or 2 billion, in the U.S., our addressable market is about 5-6 billion, and it's growing as well. Non-residential construction in the U.S. is doing very well right now. Our order books also for Ascent are on the upswing with, we're right now probably at a peak order level, higher than it's ever been, in excess of about $45 million. So, I would not worry about Ascent. I think it's a high margin business. It will continue to be a PBDT of 10% or 10% plus also. And I'm confident that we will continue to scale. And on the longer term, over the next few years, you can count on Ascent growing and by double-digit rates every year. That much is for sure.
Yeah. Good. Can I ask one more last question? Last one.
Sure.
I can. Yeah. So this is regarding the services business. Your presentation shows 29 point some crores, which I think is very high, compared to 50-60 crores annually you used to do. So is there some one-off this quarter in the services business in Europe, or is it a run rate we can just multiply by 4 and a little bit of growth would be fair?
No, it's not a one-off. I think one of the things you can take to the bank, our profitability will continue to increase. We are not seeing any, in our modeling, in our forecasting, we are not seeing any possibility of decline on an overall basis, but also specifically on engineering services, we expect this business to do very, very well for us over the next few years. So this is not a one-off. In fact, you will see increases over the next few quarters and in our engineering service profitability.
Thank you very much. Thanks a lot.
Thank you. The next question is from the line of Nilesh Shah from Arrow Investments. Please go ahead.
Hi, Aditya-ji and Shrikant-ji. Congratulations. Hi, great numbers. Congratulations. I have two questions. The first question is with regard to the Raebareli plant. So what is that plant coming up for which product category? And what is the capex involved in setting up this plant? And did we have this land already on our books, or did we make a fresh purchase towards it? So total cost towards the Raebareli plant, that is one. And the second, I would like to know the input costs that are in cold rolled steel, that is right now. If you can throw some color on what the trajectory of the input costs that are going to happen for the coming year. These are only two questions I have.
Thank you, Nilesh. Raebareli project is for our pre-engineered building capacity expansion into the north of India. Right now, our addressable markets for our PEB metal buildings business are west and south. Our north revenue is near zero. That's because for a metal buildings plant, you can really only go from about 700 to 1,000 kilometers radius around the plant, after which it becomes prohibitively expensive. Now, to combat that and to make sure our addressable market grows, we have implemented the Raebareli plant. It will, in the next couple of quarters, come online, and it will dramatically improve our revenue in the PEB business. The land for that was acquired a long time ago, actually, because our intent was always to have a North India plant. But judging by the strength of the order book that we have, we are in a position now. We are effectively refusing orders right now. Because of that reason, and making sure that North India, if orders remain a significant portion of our revenue, or become a significant portion of our revenue rather, we are setting up that plant. The total capex that envisioned is about 40 crores for that, all inclusive. And we expect the revenue increase from that to be at a pretty high asset flip, and we expect a 2-year payback period on our investment in that for that project.
Thank you for clarifying.
Next question. Sorry, go ahead.
No, there was that on the cost pressures, input cost pressure. Are we seeing any marginal cost pressures on the input materials of steel?
For cold rolled steel, we are actually seeing a decline and flatness right now. Our indicators from our supply chain is that they're trying to increase pricing by about 1,800 rupees per ton. I believe that will not be possible. In fact, there's some optimizations they're looking at in terms of importing steel from internationally, which is actually allowing us to actually maybe perhaps even reduce our input costs. So we do not project a reduction in our selling price per ton right now, if that's the question. And our input costs will not increase.
All right. You just gave an indication in your speech about 3.8% as our margin. So how sustainable is this going forward for the year? For the quarter, we had 3.8 or something. I think you mentioned 3.8.
I think you can continue to expect profit PBT value increases and PBT percentage margin increases. That is a stated goal for us to improve our PBT percentage margin. You can, let me speak of what's going to happen for the next quarter and for the financial year. You will see improvements on our current margins in the next quarter, and you will also see for the financial year in question, you will see an improvement from last year on margins. Yeah. So I think that we can cover.
No, thank you so much. And just the last point, in terms of what is the current order book size that we have to be executed over the next quarter?
Yeah, for the overall order book, I'll just hand it to Shrikant to describe what it is right now.
Yeah, right now. Yeah, the overall order book for the PEB is close to 740 crores. Railways 110 crores. Ascent, we are standing at $45 million. Not all our businesses comes with an order book, but some of these businesses comes with an order book backlog, and and boilers business, of course, with close to around 130 crores.
Okay. And this is for the next quarter, coming quarter, to be executed.
Yeah, this generally contract gets executed in a period of staggered period, in a 3 months to 6 months period, while railways will take a little longer time. PEB are a little shorter period.
No, fine, I understand. Thank you so much for answering, and wish you all the very best. Thank you so much.
Thank you. Thanks.
Thank you. The next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Hello?
Hi, go ahead, please.
Yeah, thank you very much, sir, for the opportunity. So I have a few queries. So you did mention in your opening remark that you are letting go revenues with lower margins, right?
Yes, sir.
So how do we see the growth then? I mean, are we compromising on the growth part, or how do we see then the growth that we kind of envisage this year?
So, if you're talking of revenue growth, our revenue this year will be higher than our revenue last year. But obviously, on a quarter basis, you may see as we exit some of these businesses. We've exited a solar MMS business. We've exited because we felt there's no long-term viability for that business. We've exited a solar EPC business. We've exited, or really are in the process of exiting the water EPC business. These are lower margin, lower capital efficiency businesses for us at least. There may be others who are doing a good job with them, and we want to stick to business verticals which have large addressable markets and large scalability. So the output of focusing on that is, one, your capital gets, you have more capital to devote to these businesses which can scale. And we firmly believe that the only reason companies fail is either they have bad addressable markets or they have bad assets. If our addressable markets, which we define as quote activity, is high, then our order booking will be high, then our revenue will be high. If our assets are good, then we make a good quality product, and I would include human assets in that. We'll design products well, and we ultimately will be able to operate in a way that our profits are good. So that's the driving alignment, the way we are thinking about this. We have no concerns about our ability to scale revenue. As of right now, we're putting in plans so that we can, from our current gross sales last year were 3,500, we want multiples of that as our revenue over the next few years. So we are not going to be shy on revenue growth. It is important to consistently grow revenue to also grow profitability. And while you may have moderate growth, like I think this quarter's growth was 7% on gross sales, you may have that from a quarter-to-quarter basis. But on a financial year basis, you will, and definitely on a year-to-year basis, our plans for revenue growth are solid, are set. Our pre-engineered building business, for example, will grow at double-digit rates. Our industrial components business will also grow towards the later half of the year. Hydraulics is doing quite well. Our BIW business may double in size. Our US business is growing. Our railways business too has seen as an increase. So there is, I can without any reservation commit to you that our story is a revenue growth story and a profit growth story. We're not going to be stuck at this revenue level, if that's the question you're asking. Or we're not going to see moderation on a year basis. You can expect growth.
So on a year basis, maybe what mid-single digit to high single digit growth would be the range we might be looking at, right?
For this financial year, I would say, yeah, please do assume that, sir. But for the next financial year, not on revenue, on profitability, growth will be very high, because not only are we replacing old revenue, we are growing. What's growing is growing quickly enough to actually deliver overall growth. But from a profit point of view, because of margin expansion, you will see, far higher growth rates, double-digit growth rates. I think that's what we said last year.
I was trying to understand the revenue front. Profit growth obviously should be higher, because you did mention that PBT margin should be higher on a YOY basis, right?
Yeah.
So a high single digit is a fair estimate, right? I mean, in that range.
I would prefer to continue to give quarter-on-quarter projections. But yes, you can assume that for the year, that is what we are looking at. There may be some improvement on that towards the end of Q4 when our new Raebareli plant comes online, our hydraulics capacity comes online, our aerospace capacity comes online. Ascent's going through a capex phase right now. That also gets commissioned in November.
Understood.
So you may see some higher revenue growth rates in Q4, but over the next few quarters, next financial year, for the financial year, you will see growth, and revenue growth is a very, very important part of our overall growth strategy.
Understood. And secondly, I was looking for some thoughts on your railways business scale-up, because if you see, railways are giving a lot of orders, right? And our order book of 110 crores looks very small in the kind of orders they are giving. So are we looking to scale up this railway business, or do we have the capability to do that? So any kind of thought process in that area would be helpful.
Right now, we are not looking to scale up our railways business in the sense that what is there is there. We have an asset block, so you will see a certain percentage growth rate in our railways business, but it is not a focus area for us. You are not going to see this business 3x or 4x over the next few years. The businesses which we are looking to grow at a very fast clip is our pre-engineered buildings business, hydraulics, our boilers business, and also our BIW. Engineering services also, while it is low in revenue, but it operates at a 20% PBT, also will see very high growth rates. So these 6 business units are the one which will drive our future growth. Railways will not reduce or die, but we are not focusing on that area as a growth area.
Okay, but what is the reason for that, sir?
Just the way we are structured, sir, I think there are many opportunities. Pennar's footprint, our technology footprint gives us access to automotive infrastructure, yes, railways and aerospace, but for anyone, capital is always going to be a constraint, and I think it's better for us to focus on these 4-5 business opportunities and make sure we hyperscale them as opposed to trying to grow all 8 or 9 of our business verticals. That's the thinking. It is not a judgment on railways. And as you yourself have said, there are a lot of people who have very large order books in railways, but we prefer the private sector. We prefer the capital goods sector.
Okay, understood. And sir, my third question is on your PAT. I mean, we have, had an aspiration of 5% PAT margin, right?
That's correct.
So what is the sort of timeline we are looking at in terms to achieve those sort of margins?
So you will see steady creep up quarter on quarter on our PAT percentage margin. On a timeline for 5%, I do have the answer, but I want to, I don't know if it will be a forecast or, let me get back to you on this. But it's not multiple years from now. It's quite soon. But please excuse me if I don't give you an exact quarter.
Oh, I mean, 1 to 2 years would be a fair range. I mean,
yeah, 100%. Yes, that's for sure.
Understood. And your other income, I mean, it has been quite volatile, right? I mean, how do we see that? I mean, in some of the quarters we get, 2-3 crores of other income, and some of the quarters we get 10-12 crores of other income, right? So
it's just an attribution. I think we discuss with our auditor what they want us to use in the revenue attribution. My request would be that you combine other income in regular sales and then look at the overall number. I agree with you. It's very confusing when other income moves around so much. Correct. But effectively, a lot of the classification also has to do with what is being concerned. I mean, it's not just interest income. There's a lot of other things in that. My request would be that you give us the leeway to add other income and look at the total income, because that's how we see it as well. And the attribution of it is very volatile based on what our stat auditor says is the way to do it. So, request your understanding on that.
Understood. But what is the nature of this other income? I mean, how much would be the interest income, and what is the nature of other part of this other income?
Our interest income would be small, about 2 crores. The other part of it can include scrap sales. It can include
incentives that we get.
It's
foreign exchange fluctuations gets accounted there.
Yeah, forex fluctuations, all of those things. Which is why if we have a certain product which goes high in a quarter, we look at it on an overall basis, but the attribution basis, I mean, by accounting standards, we need to put if there's forex fluctuation, if there's interest income, if there's scrap sales. So there are a lot of components in that. That's the reason it moves around a lot.
Understood. So, sir, I have one final question, if I'm allowed to ask.
Yeah, please.
So, how do we calculate ROC? I mean, because you said that FY23 we had a ROC of about 20%. But if I see your debt and equity in FY23, our total capital employed is about 1450 crores. So I am getting a ROC of about 10-11% for FY23. So how do we calculate ROC of 20%? So what do we exclude in capital employed?
Basically, we take EBIT and divide by the capital employed. Basically, total assets minus the current liabilities.
Okay. Because, I mean, ideally we take debt and equity, right? So that is about 1400 crores total employed in FY23.
Yeah, you can take total assets minus the current liabilities, and that's how you calculate the capital employed.
That number?
949 capital employed.
Yeah, so that's what you're taking is 949 crores is what we're taking. So I think we're not removing the current liabilities. That's probably why I think you're taking total assets, sir. I think we're removing the current liabilities, which gets us to 949 crores. That's the difference in the calculation. And our calculation is the approved one, if you want to call it that, because that's the actual capital that we're actually deploying in the business.
Okay, understood. Fair enough. Okay, yeah. I think that's it from my side. All the very best to you, sir. Thank you so much.
Thanks so much.
Thank you. The next question is from the line of Keshav Garg from Counter-Cyclical PMS. Please go ahead.
Sir, I want to take from the previous participant's question about return on capital employed. Sir, I don't know why you are taking out current liabilities. The the calculation should be total assets by EBIT, EBIT divided by total assets. So if we should add debt plus net worth and minus whatever cash that we have. So it should come to around 1263 crore for FY23. And on that, sir, the EBIT is basically 235 minus the depreciation of 66 crore, which is around 169 crore. So the return on capital employed is actually 14%, and that is the normal way of calculating across companies.
Okay, we've used this for last quarters. If you would like us to change and start working on that calculation, we can do that as well.
Yes, sir. And sir, so why have the margins declined quarter on quarter from 10% to 8%? I'm talking about Q1 versus Q4. And sir, despite the increase in scale of operations?
Yeah, so we do have some orders that come in the fourth quarter which tend to be higher margin. These include our BIW tooling revenue, which comes in, gets recorded once a year. So that tends to push up Q4 margins. But on an overall year basis, obviously in this year too, we will have the same impact of some of our revenue for our BIW tooling projects getting recorded in their entirety in the fourth quarter. If you were to look on a year-to-year basis, you will not see a decline in our margins.
Sure, sir. And sir, if we look at, like you mentioned, that the aspiration is to reach 5% net profit margin, in that too in the, let's say, in the short to mid-term of, let's say, over the next 2 years. So, but if we look at our current net profit margins, they are approximately 2.8%. So that means we are almost talking about doubling the net profit margins in the next 2 years. So you think that that's a reachable goal?
Yes, we do believe that to be a reachable goal on the back of us focusing and shifting our revenue attribution to higher margin businesses. That plays a massive role. Frankly, that's the largest role. In addition to that, when you scale revenue a little bit, which we may not see a tremendous amount of that in the next quarter or two, but for the whole year and of course in next year, what we do definitely have a lot of confidence in is that the revenue scale up combined with, which makes your fixed cost, of course, you can distribute it over a larger asset base. That combined primarily with focusing on higher margin products will ensure that our net profit margins increase dramatically. So that we're confident of.
Sir, that is very reassuring. And sir, lastly, sir, we are doing share buybacks every year, and that's the really great. Sir, and last year we did in September 22, so 1 year is about to get over. So I hope that we again do some share buybacks, especially considering the great plan and the bright future that we are projecting. So that's a request from all the shareholders.
Yeah, thank you for that. And we do take that. As you must be aware, we have done buybacks many times over the last 10 years. I think we would have done 5 buybacks, if not more. But the board will takes calls on corporate actions on a very frequent basis. We meet very often. We meet during the quarter. As and when the board determines the timing is right for another buyback, we will absolutely communicate that to shareholders. But thank you. But we agree with you that that buybacks are a good instrument for retiring low-cost equity.
Sir, and one thing, sir, SEBI is phasing out open market buyback in, so this is the last open market buyback, and henceforth from next year onwards, we can only do a tender offer wherein a premium needs to be paid over the market price. So you can just keep that in mind. Thank you.
We'll do that. And whenever we've done a buyback, we'll always done it at a premium to what we've offered. I mean, there's a range that is offered, and that's always been market price plus. So yeah, but I will try to educate ourselves on any precise change in rules before any corporate action declaration is made.
Sure, sir. Thank you very much.
Thank you. Thanks.
Thank you. The next question is from the line of Dilip Kumar Sahu, an individual investor. Please go ahead.
Okay, am I audible?
Yes, please go ahead.
Yeah. Two questions on, a lot has been talked about 5% PAT in 2 years. If I look at the products versus project business, the PATs are very different, right? So, are you saying that you are going to restrict the project business going forward to increase the PAT margin, or you think that we will go at 18, 19, 20% and still meet PAT of 5%?
So project business, no, we're not saying that at all. So I think our project business, which is pre-engineered buildings, is one very big component of that. Will scale. We believe that there's a very high addressable market for us, and as I mentioned on the call, we're setting up a new plant in North India. We're expanding capacity in Hyderabad and in Chennai for pre-engineered buildings. We're also expanding capacity in our US plants right now. So our project businesses will scale. Yes, you are right that right now project businesses comes under a lower PBT than product. But what is going to happen is as the revenue of these businesses increases, I think the entirety of a project business also moves into the high PBT margin, and the combination of all of our project businesses will trend by itself above 5% PAT. So, for example, we are projecting in the US that we'll reach 10% PBT. So no challenge there, sir. We will be able to grow our projects business and make sure that we take care of the bottom line. So that is we're not saying we're going to decline.
Good to hear. Only that it's very difficult to do India project business at the kind of margin you're talking about. Most of the competitors are not doing that. Anyway, that's a comment. My second question is regarding this stainless steel business expansion in Velchal. We have been talking for quite some time, right? Almost a year or so on starting this project, and you have the land, and this is obviously a business where there is demand is far ahead of supply. So, is there some seriousness in terms of because everybody is coming with capacity, so we should be coming with the capacity when the demand has fallen short, right? So that would be double whammy in terms of negative side. Any thoughts on that stainless steel expansion and investment, and in general, what is the investment outlook for next 24 months?
Okay. So two parts of one. Just to refer back to the last question, I don't want to hurt myself on this, but actually our competitors in PEB do higher margin than us. It's something that's why we are improving now, because we've decided to put it on it. For the largest company, I won't name names, but the largest pre-engineered building company in India, who are 2.5x our size in terms of revenue, actually has an 11% PAT. So, okay. So there is it's not going to be difficult for us to reach 5% plus for our projects business. Regarding Velchal, by stainless steel, do you mean a stainless steel tubing?
Yeah, stainless tube. I think you had plans of expanding this. You have a very small capacity in stainless SS tubing, and there was a plan, if I remember correctly, around 1.5 years back, to expand that in Velchal to substantial capacity. We
did, but I mean, our current capacity of stainless steel tubing in Velchal is not very high. Even after the capacity expansion, it's not very high. Right now, we are focusing on large diameter tube, which would be 8-inch and above tubes. We can use that for torque tubing. We can use that for hydraulics. We can use that for automotive as well. That is a massive high margin market that we want to cater into, and it's right now served by very few players in India and even internationally. As you may be aware, we supply a lot of tubing to the US as well from our India plants. So we also want to grow that aspect of it. SS tubing continues to be a focus area for us, but we are not going to be deploying capital into that business. Now, for our large diameter tube, we will be deploying about 30 crores in terms of our capex in this financial year. I think those were your questions.
No, the whole, if you can just tell me the investment plan budget for this year. I mean, this year means basically the next 18 odd months overall for the company as a whole.
So, I will get back to you on that next quarter, sir. Hear me out. The reason why I cannot give you that number right now is it's not been finalized. We are still debating the exact outflows we will have for our hydraulics business. We have also a BIW business where we have some visits from our partners, technology partners. So it has not been frozen yet, so I cannot give you this year's. I know it is very late in the year, but we unfortunately have not been able to close our overall capex outlay. But I can tell you what has been decided, which is our pre-engineered building line, that goes on, and that is about 40 crores, and the tubing line, which is about 30 crores. That has been finalized. Ascent also will be growing, but most of the capex has already been spent, so there's only a couple of million left. That's about 15-16 crores left for Ascent. So that's what's been done so far. I will not be able to commit on an overall number for the year right now.
Sure. No issue. And in terms of the railways business, for this 110 crores, typically they have 3 to 4 months of cycle time, right, in execution. So are you talking about 350 crores of railways business this year?
So the order book we have for railways is longer term gestation, sir. It can go into 1 year also. It's actually a longest gestation order book. Everything else is a lot shorter. So the revenue base we're expecting for railways is not 300 crores, but again, we will not be able to give you an exact number for the year, but it's not 300 crores. It would be lesser than that.
Yeah, because you reached a peak of 350 crores, I think, 2017-18 or something like that. That's all. That is a highly profitable business from what I understand.
It continues to be a good profit business, sir, but we are not targeting 400 crores in that business. I think this pre-engineered building for us can be a multi-thousand crore business. Hydraulics can be a multi-thousand crore business. BIW can be a 10,000 crore business for us over time, not right now. So we are focusing on those. Railways will continue to be a good margin performer. We'll scale it at a certain rate, but we are not looking at massive investments in that business for the reasons I mentioned on a previous question.
Sure, thank you. Thank you very much.
Yes, sir.
Thank you. The next question is from the line of Chirag Shah from Nidara Capital. Please go ahead.
Good afternoon, sir. Can you hear me?
Yeah, please.
Yeah, congratulations on a good set of numbers. So I had a couple of questions around the PEB business. Is there any seasonality that you see quarter on quarter in this business?
Usually there is. The Q2 tends to be the lowest, but in the current circumstances where our order books are extremely loaded and there's a lot of pressure on us to supply, and also we've expanded capacity at our Hyderabad plant. Even before the larger plant capacity comes online, you will not see this traditional seasonality this year. You will see an increase in sales in PEB.
All right. So one more question on PEB. So is it possible for you to give the revenue Q1 FY24 versus Q1 FY23, the EBITDA margins and the order book comparison compared to last year, so we get some idea on
sure.
the category?
Is that information segmentally given out?
Yes, segmentally we have given out this information in the segment reporting pattern. So if you see custom design building solutions and auxiliaries, that's where the information is already included.
Okay. And so, say compared to last year, is there more, positivity in the sector, or
yes?
How do you see the growth, spanning out for the next 1 year or 2 years?
Quite high. As I said, right now it's taking a push from us to convince our CEO in that business to expand order book because he's full. But the moment our additional capacity, and it's a very significant addition of capacity, comes on, then the larger order book. And order book is always pre-booked, right? So considering that the capacity increase is imminent, I think I can project that This year compared to last year, our PEB growth sales, our net sales gross profitability will be quite high, and that trend should continue, both in India and in the US, both.
Okay. And so specifically with respect to India, how do you see the margins improving with new capacity coming on and, your order book fill up? How do you see them improving?
Margins there are about 15%, including credit cost, of course. But so another way to look at it is every additional dollar of revenue in the US, every additional rupee of revenue we add in India, we're adding at 15% here, and in the US it's even higher. So we don't anticipate any margin issues. I think scale should give us the ability to expand margins in this. I think we had said 5% is our target. We'll attempt to beat that.
At the PAT level?
Yes, sir.
Okay. All right. Thank you so much, sir.
Thanks.
Thank you. The next question is from the line of P. Jha, an individual investor. Please go ahead.
Yes. Hi, Aditya. It's always very refreshing to listen to you.
Thank you.
So forthright and so encouraging with a positive outlook. I have two very specific questions. One is, definitely you're not a real estate company. What is the surplus land, the value of surplus land that you have, which you are not going to be putting to use in your manufacturing activity or any business activity for that matter? Number one. And number two, I would be interested in knowing the list of customers in your railway-related businesses, the coach primarily, or the metro listing, other than Bombardier and ICF and Titagarh and Texmaco, if there are more. Just the list of them. Because as some of the previous speakers said, we still believe that this is one business which is looks evergreen for the next decade, with 3 lakh crore investment every year, and which is happening. So perhaps even scalability to the extent of 500-600 crore with decent margin is a great margin to look for in order to achieve your stated goal of 5% PBT. And regarding the real estate, I always believe that if you are debt reduced company, or that fund if you could utilize in your bank early, it would be in everyone's interest, primarily in the company's interest, and followed by shareholders' interest. That's my opinion. Thank you.
Thank you, sir. So your first question, as you said, we're not a real estate company. So while the company holds on to substantial land assets, these typically either are land assets where there's an existing factory which is operating, or they are assets which we have acquired, like Raebareli was acquired a few years ago, with the intent of putting up a plant at that location. So shall we say the liquid land that comes up, which can be sold, which is not going to be used, typically tend to be those assets which are currently being operated or have just stopped being operated because either the city has grown beyond that range, or because of whatever reasons we are not looking forward. It's become more expensive to operate over there. By that metric, I think two of our plants suffice. One is Patancheru and one is Isnapur. These are substantial land assets, but we, as of right now, have not made a plan to liquidate them. We've liquidated some portion of our land about 2 years ago. I think we are looking to potentially, once we have removed all of our manufacturing assets from these locations, we will look to liquidate. But as of right now, I don't have anything to share with you. We will. There is a discussion on the board on this issue, but we will look to liquidate it. on our railway business, as you had said, we supply for coaches and wagons. We supply components and subcomponents. So for coaches, for example, we make end walls, side walls, roof assemblies, trough floors, underframe components. Coaches for wagons, we make wagon components which are integrated by the wagon manufacturers, such as what is a Titagarh. But ultimately, our ultimate customer is always the railway board, and I know that they are giving a lot of orders, and in fact, for Train 18, what's called the Vande Bharat Express, in fact, a lot of the product development was from a structural components point of view was us. As I said, it's a multi-100 crore business. It will continue to be a multi-100 crore business, and a good margin. But I think there are our primary customers for example, coaches is ICF and MCF, and I don't believe, at least it's my opinion, what we have taken a call as a corporate. We don't believe that a multi-year sustainable revenue plan can be made based on our current profile, our current value proposition to railways. If we do want something like that, we need far longer term contracts. We need lock-ins in terms of what the capacity and outflow our customers want is. The current environment where there's a lot of announcements made, but has there actually been an increase in the number of rakes produced by ICF? My thinking is no. So we have decided as an organization that we will make railways grow at a certain rate. We will deploy capital. But since the railway board ultimately controls most of the, at least if you're India-specific business, ultimately, whether it's Western Railways, whether it's wagon manufacturers, whether it's coach manufacturers such as ICF, MCF, whether it's the bombardiers, all of this, ultimately it all comes to the railway board, and we don't like single customer businesses. So we have decided that we will scale it in a certain way, but the businesses which we have prepped for hyper growth, railways doesn't figure in that. And there's nothing wrong with that per se in our view, because just focusing on our hydraulics, BIW, our engineering services, our pre-engineered buildings business, and focusing on the India, the US, and Europe as geographies is giving us revenue growth, is giving us margin growth. We capital efficiency, not very, very happy with where it is, but look forward to making it better and better. So, in my view, sir, I think we have a robust growth plan for revenue. We have a robust growth plan for profitability. That's fine, I think. We don't need to chase every opportunity that is possible for us. So, railways, the answer is no, sir.
No, fair point. And in any case, till such time it keeps happening, why not run with it? And perfectly, it just reminds me of your, perhaps the conference call of first quarter of earlier year, or whereabouts around that time, wherein you had specifically mentioned that the margins in the US is as high as 20%, or is likely to be 20% or some such thing. You think that we have achieved, or we are likely to achieve in the near future?
So on the PP margins, from an operating margin point of view, we're well above 20%. Now we are closer to 32. From a net PBT or PBDT point of view, we do believe that 10 to 15% is absolutely achievable, and we are trending above that. As of right now, we're trending at that level. So,
yeah, and $45 million is the current order book, and likely to.
Projected revenue this year will be far higher than that. It's a very short order book cycle. Shorter.
And it could be double of this?
It would be close to that, sir. Sir, could you get that?
Yes.
Thanks.
Thank you. Ladies and gentlemen, we will take that as a last question. I would now like to hand the conference over to Mr. Vikram Suryavanshi for closing comments. Over to you, sir.
Yeah. We thank the management for giving us an opportunity to host the call, and thank you all for being on the call. Sir, any closing comment from your side?
No, thank you. I'm grateful for the questions. I'm grateful for the participation, and we look forward to executing on the plans that we have talked to you about. Thank you very much to all of you.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.